I think it's fairly evident to us that the RBA will be required to continue to do some of the heavy lifting in Australia. We're not going to get any fiscal stimulus anytime soon, and certainly the currency, whilst it's depreciated a lot versus the US dollar, that's been mainly US dollar appreciation rather than Australian dollar depreciation. If we look at the Australian dollar in a trade-weighted basket, it's actually only off about 3% in the last 12 months. And that surprises a lot of people because they often see the spot price on the morning news programs or the like. But in terms of our trade partners, being predominantly in Asia and predominantly in Europe, they've also been weakening their currencies at a rapid rate under quantitative easing from the Bank of Japan and from the ECB. So we don't have that kicker that we would otherwise normally enjoy via currency depreciation as things get difficult. And so we feel that the RBA can continue to support the economy by lowering the currency materially, by taking interest rates lower. And I think a lot of the negative feedback loop that we were otherwise seeing in property markets and the like, which have been very robust at clearance levels, certainly in Melbourne and Sydney, auction clearance levels on weekends following previous RBA moves. That's tightened up a lot as a result of the macroprudential legislation which has been enacted over 2015. We've seen investment lending really come off and cool to the point where maybe that's much more controllable. I think the RBA don't want to be blamed for blowing a property bubble, and I think they'd be very happy to see property just trend sideways. I certainly think that they're very reluctant rate cutter, and they're reluctant because they need to keep their ammunition dry if there really is more to do later on. And certainly if they do come in off the sidelines, we wouldn't expect it'll be a tweak of say 25. We would think it'd be a series of moves at least 50 basis points, probably delivered over 2 meetings. At the moment, we're thinking May and August. The markets are very much with us. The probability of a May rate cut in market pricing at the moment is around 80%. Look, I think the RBA have ammunition. I think in what has become a global currency war, Australia really stands out. We have very high interest rates comparatively to a quarter of the developed world is now at negative interest rates. Europe, Japan, Switzerland, Sweden and Norway, these are really real developed places that are now at negative interest rates. And so Australia stands out as extremely attractive given our AAA credit rating, our Westminster system, and we have high liquidity now. As we mentioned, that the bond markets have grown to a size where they are really liquid. It's very easy to transact in large size and transact quickly. So it's a very attractive place for international capital still. And that's part of the reason I think we're not seeing the currency rotate lower. Ordinarily in a deleveraging environment in the markets, as we're seeing, the currency would wash out with that deleveraging process. But the currency has been really quiet. It's just hovering around this 70-cent level. I think it obviously had a large move versus the US dollar last year, but on a trade-weighted basis, we still need a lower currency over time.